So welcome to the Entrepreneurship Drive. Today I'm very excited and looking forward to hear about taxation and to get smart about it. We have Wilson Kamau, who is the director of Alpha Cap Limited. He's the expert and is going to take us through this so that we get smarter in this area. So thank you for welcoming us here. And I think we can dive right into it.
Okay.
So I'm just thinking, as a business who is beginning, where should I begin, let's say as a self-employed person or a business that is just newly registered? Where should we begin on this issue of taxation?
Okay. Thank you so much, Eric. Thank you for having me in this conversation. And I hope it will add a lot of value to the viewers. Just to your question, where do you begin as a business owner? The fundamental thing to understand is what is tax and how it comes about. So tax is levied by the government to help it collect revenues to provide services that no privateer or private company can provide. So it provides public goods. A public good is a road, access to health, access to street lighting, access to things like water. So the government needs revenue to do all those things that cannot be done by a private company. So every person who does business or earns an income, that is very, very critical, is obligated to pay tax so that he can able to fund the government activities that are for the greater good and not just for one person. Yeah. So that's very fundamental. So as a business owner, so one of the first things you need to do when you do business, the goal of that business is to make a profit. You don't do business for anything else. You do the business so that you're able to make a profit and use that money to feed yourself or to grow the business. So taxation, the first thing that tax does is it takes a portion of your profit, and that's what I want to drill down into. Tax is levied on income. In tax lingo, it's called profit is called income. How much did your business earn in a particular year? So that's called that income is what is taxed. So tax is levied on income. It is levied on the excess money that you make, in a sense. So as a business or as a business owner, when you do business and at the end of the year you make profit, the government comes for a portion of that profit as tax that goes towards funding the government activities.
Mm-hmm. I hear these days they come for it even when you're not making profit in some areas.
Yeah, so they're trying to bring up that aspect of you pay tax regardless of whether you make a profit or not, but it's currently on hold because there's a court order that put it on hold because it raises another aspect of it. You see, you can't, if I'm paying tax and I'm not making a profit, basically it means I am taking money from my capital and paying the government. That's counterproductive. I can't be investing in a business, then using the same business to pay taxes. Yeah. It's very, very counterproductive. So that's been put on hold for the courts to decide. It has, if you're looking at on the perspective of the government, is that it's more like they want everybody to pay a share, an equal share of tax. But you see, at the end of the day, if you can't tax my capital,
it wants to cast the net wider.
Exactly. So they're looking for more and more ways to get closing on getting more revenues. Yes, to fund their budget.
Mm-hmm. So as a new business owner, what are the elements that I need to put in place the day one? Maybe I think I'm looking at different entities. I could be self-employed, or I could be having a business that is registered, for that matter. I think from that perspective, could they be doing different approaching taxation in a different manner, or they're approaching taxation in the same way?
So good question. So one of the things, so in business, as a business owner, you pay tax on your income, which you have defined as your profit. So all businesses are run basically the same. So what happens is that you sell something that to a customer, he pays for that something. Then as a business, what you do, after you deduct the cost that incurred for that sale to happen to arrive at your profit. So if you bought something at say 20 shillings, sold it at 50 shillings. So you made a profit of 50 less the 20, so you made a profit of 30. So that 30, you pay tax on that 30. That's how most businesses work. So the goal, every business has to, number one, maintain a record of their sales and maintain a record of their expenditure. Then the difference between your sales and your expenditure is what determines your profit. So sometimes if your sales is less than expenditure, you'll be in a loss position, then there's no tax to pay. But now if you're in a position where your sales are higher than your expenditures, then you'll get a profit and you'll pay a tax on the profit. Now critically here, sales is basically what the customer has paid for. Expenditure in tax lingo is very clear, in the law is very clear. An expenditure can only be called an expenditure if it helped you make the sale. So an expenditure is nothing else. If you can't buy a shoe for yourself, then say since I use business money, then that's an expenditure. It's not an expenditure. It did not help you make the sale.
I cannot do shopping for my house as a director
exactly.
and say it is a business expenditure.
Exactly. It did not help you make the sale.
Okay.
So as an expenditure is something that helps you make the sale. So if you bought a piece of furniture for selling, then you sold it. To see the cost of that furniture is directly linked to the sale. Other aspects of it is that, for example, if you had to employ a salesperson to help you make the sale, that is an expense. If you had to make a telephone call to follow up on payment, that's an expense. If you had to pay rent for your premises, that's an expense. If you had to pay transport to deliver the goods, that's an expense. So anything that directly links to the sale is what we term as expenditure. And anything else is not a valid expense. So that's very, very critical for business owners to understand. So back to this. So when you take your sales less expenditure is your profit, and you pay tax on your profit. Now, how you pay tax on your profit depends on two critical things. Are you a self-employed person, or are you a registered limited company, or a registered legal entity? I'll come to the different legal entities. But I'll start with the self-employed. Yeah. A self-employed person pays income tax not at a fixed rate, which is very important. So a corporate entity or a limited company pays taxes on a fixed rate, which is 30% of your profit is paid out as taxes. It's very, very critical. That's a fixed rate. So whatever profit you make as a limited company, you pay 30% as tax. For a self-employed person, and this is somebody, for example, if you're a consultant and you offer services as a consultant, then as yourself as an individual, that one, and also people who are called sole proprietors, or for example, who you are running an organization as a sole proprietor. Basically, the business is the owner. The owner is the same person. The owner and the business is the same person. You're running it. It can be registered as a sole proprietor, but still it's just one entity, basically a sole proprietor. Yeah. So that one. So those two people, the person who runs it under his own name or as a sole proprietor, they pay taxes on what we call a graduated scale. It varies. So you pay taxes in three or four tax rates. So it's taxed on a graduate. So the first about 200,000 is taxed at 10%. The next 300,000 is taxed at X%. It's about 15%. And the last is taxed at 30%. It's a graduated scale. It's not a fixed rate. So it varies for individuals. It's not. So in your profit for the year, what happens is that the first, say 200K is taxed at 10%. The next 300K is taxed at 15%. The next is taxed at 30%. It's a graduated level scale. It varies. So it's not a fixed rate, unlike limited companies. So limited companies just pay 30% flat out on the how much profit they made for that particular year. Yeah, that's clear.
So you're saying that for an individual, they pay taxes. For a sole proprietor, for that matter, they pay taxes in a graduating manner.
Yes.
And this is in a year.
Yeah.
So do they wait for the end of the year, or do they pay in between the year?
Okay, good question. So I think this now comes into the elements of what we call tax. Taxation has a basic elements. So for example, the government always needs revenue. So this is, for example, Government is paying for public servants and they pay them every month. So if they have to wait for every end of the year to collect taxes, there'll be a big gap in terms of funding, and they don't have money. So they always need money sort of every so often. So for most of the taxes that are in play, they're not really paid at once or at the end of the year. Most of the taxes that are in Kenya. So now coming back to what income tax for individuals or for company. If you are running a business and you are ought to pay income tax, you don't pay it as a whole. So, and this is where it may get a bit complicated in a sense. So, if you start a business, this is the year 2021. Mm-hmm. Ideally, what the government tells you to do in terms of taxation, project how much profit you will make in the year. Just project, can be just give it a sense of, based on your business experience, how much do you think you will make in the year? Based on that profit, so you calculate the tax on that profit. Then you split it into 4. You pay it in 4 quarters. So for businesses that runs from January to December, you pay it in April, you pay it in June, September, and December. You pay that tax, whatever you're projected. Now, after end of December, after you've done your books for the year, and you look at the profit you've made, and you look at the taxation that you are ought to pay. If the tax that you paid in that quarter is less than what you should have paid, any balance that is unpaid will be paid by the next year, by April the next year. You have to pay any balance by April of the next year. That's how basically it works. Then now going into the second year of business, the taxation that you will pay in those quarters is 10% extra of the tax you paid in this year. So for 2022 now, for example, whatever tax I paid in 2021, I'll pay 10% extra in those quarters. And that's what we call installment taxes. You pay it in bits.
You pay it in installments.
Exactly.